There's another rule on the 1031 that is very important, that needs to be the same entity that is buying and selling. You cannot assign to another person or another company, correct?
Yes, that's true.
What happens? What happens? Okay, Daniel did it for 30 years. Not Daniel, John.
Okay. So an individual.
John dies. And this property is going to pass to his son. Who is going to pay the taxes? What's going to happen?
The estate of John.
Okay. So that's going to be calculated for backwards on the last 30 years, the amount of money that he didn't pay, and on that moment.
No, it's just in the last transaction. No?
It's the gain, right? It's just it's just the profit. So
yeah, it's just a profit.
If he sells it. So for example, John passes and his son is now going to sell this property. There's going to be a gain. And remember, the son did not buy the property or use his own funds. I mean, every case is different, but
but that's the question. Daniel started with $100,000. Throughout 30 years, now he has $1 million. John has $1 million.
It's not $1 million minus 100, and all that's subject to capital gains. That's why you have a CPA involved to depreciation schedules and what you invested over the years and things like that.
Okay, but the difference is capital gains. Let's say not 900, but it's 500.
Yes. Remember, the first step too is getting your CPA to say like, what is your profit here?
So after John dies, and now his son John Jr. has the property. Now on that moment, the capital gain from the past that John didn't pay needs to be paid on that moment.
When he sells
it doesn't have a sale because he died and he's passing his property.
Like he inherited the property.
No.
Who's going to pay for that?
But that is not called a capital gain though. That's just like a profit that you're bringing a whole other subject here.
Yeah, I know
which
that
is
the
estate tax.
I know the capital gain is going to be realized when someone sells the property, but based on the 1031 exchange rules, where you can only apply that to the same entity. Now is John Jr. who is selling the property.
But
John Jr. is going to pay only for the moment that he had the property for the capital gains, or for the whole period that John Sr. didn't pay for?
For the full gain. Basically, if he's acquiring the property for the certain amount, he didn't purchase that property. So whatever the gain is based on that sale is what he's going to pay taxes on.
On his gain. So wherever the IRS didn't collect for the last 30 years that John Sr. was doing, is never going to get paid? That's my question. That's my question.
That's a good question. And in that case, 1031 wouldn't come into play because now we are talking about something that you inherited. And when you inherit something, that's a whole other tax.
Different type of tax.
You can't get like double and triple tax. You can't have a capital gain tax and an income tax and on this property that you inherited.
My ultimate question is, for the last 30 years, John Sr. was applying for the 1031 exchange and never paid for the capital gains because he was applying for the 1031 exchange.
Did he hold this one? He held this one property.
Yes,
so he never applied for 1031 actually.
No.
Applied.
No. He bought it, he sold it, he bought it, he sold it, he bought it, he sold it during 30 years. He bought it and sold it, I don't know, 10 properties. I don't care.
Right. The 10th property is the only property that is going to be considered as a realized income or realized profit for the junior.
So junior is going to pay for it.
No, but doesn't pay for. He just pays for the gain.
Yes, I understand.
But you're asking about the last 30 years. But the last 30 years wouldn't apply to John Jr.
Exactly.
John Jr. is only dealing with the last property.
John dies, it dies with him.
That's what I'm asking. So all those taxes that were deferred, who is going to pay in the end?
You are okay. You don't pay a capital gains tax on all of the gains over the last 30. You're only doing it on the last property that you're selling. You're cashing in a property, right? You're not going to reinvest it. Well, the gain from that transaction. So if John Sr. purchased a property in 2018, in 2018, okay, John Sr. using capital gains from another investment purchased an investment property in 2018, and he died in 2020. Between 2018 and 2020, what was the realized profit?
Like, it doesn't accumulate over time.
No, it's not like compounds.
It's not like you sold it in 2000 and you owed 5,000.
The 1031 wouldn't even exist because you're not, how do I say, you're not really gaining an advantage there. That's all compounding.
Of course you're gaining an advantage. But
you're not cashing it.
Now I have double advantage. Because if I buy a property for 100, sell for 200, and I don't apply for the 1031 exchange, and I need to pay taxes on it, I don't have 200 anymore to reinvest. I will have 180. I don't know. I'm just guessing. 180 to invest. So over the years, there I already have a very good what do you call a very good deal on the 1031 exchange, because I'm reinvesting the full amount of money. I'm not taking part of it and paying taxes. So basically, I'm reinvesting the taxes that I would pay if I didn't have applied for 1031 exchange. So what you're saying now is that not only I can reinvest the full amount of money that I'm making, I'm only going to pay taxes in the last transaction. It doesn't matter. It doesn't matter if I started with $100,000 in property and now I have $1 million. If I bought the last one for $1 million and sold for $1.2 million, I'm only going to pay capital gains on that too.
Yes.
If I'm the IRS and if I'm a QI, I am looking at this transaction of this one property that was purchased in 2018 and now is being sold in 2020, whether it was by John Sr. or John Jr., and they are not going to be reinvesting those proceeds into another one. It's the gain from 2018 to 20. Yeah, that's it. Now,
so everybody needs to do 1031 exchange if they are doing investment.
You don't have to. You could take the proceeds because you need it to buy a car, to give it to your kid to go to college. But you're going to pay taxes on the gain.
Yes. But they have to, because you save a lot of money.
Oh, okay. Yes, of course. But
you're never cashing them. You're never cashing it. So basically, you're just reinvesting all the time. So basically, you're never cashing them.
For people that have part of their portfolio to real estate, they need to use 1031 exchange because over the years, they are going to save a lot of money.